Hello, I'm Jeff Bermet, manager of the Libero Cautious, Dynamic, and Solutions funds. July was a good month for all of our portfolios and generally a good month for markets, but with a great deal of intra-month volatility. We saw oil as low as below $80 a barrel at the beginning of the month when we were hoping that this memorandum of understanding between the US and Iran that had been tentatively agreed in June was going to take further shape, and there was going to be an open Strait of Hormuz and a free flow of oil, and oil was below $80 a barrel. The war suddenly resumed, and oil touched $100 a barrel again in mid-July. We feel very confident that oil is not returning to the prices you saw before the war, and the energy sector holdings in our portfolio were a great boost to the returns in July. And in fact, as I look through the variety of themes and sectors in our portfolio, defense did very, very well after, I would say, a very weak first half of 2026. That whole sector, all our holdings in defense gave us low to middle or to mid double-digit returns for the month of July. So we were very pleased to see that. And we see that as an ongoing theme in the portfolio, that defense spending is on an inexorable rise higher, and these companies will continue to post, I would say, very strong earnings and have long order books that are only going to get larger in the months ahead. The minerals and materials sector, our mining holdings did very well again as the AI spending and the demand for more power just continues to drive up the price in copper. Miners are benefiting from the expansion of defense spending, as well as a lot of rare earth metals and other materials that the miners produce are needed to produce the sophisticated weapons. In the healthcare space, we own both Novo Nordisk and Eli Lilly, and they've done well for us as the demand for GLP-1 drugs and variants on those drugs keeps growing. So we expect to see more gains in that space. I think last but certainly not least, technology. Technology was all over the place in July, and it really depends on what sector you're in. We had done very, very well with our holdings of chip makers, the memory chips that are needed in the AI space to assist, and in some cases maybe even replace, the graphical processing units that NVIDIA manufactures. So we saw enormous performance in the second quarter in those names, and we felt some of that performance was so astounding that we took some profit in June. Thank goodness we did, because July saw a very, very sharp reversal in a lot of the chip makers' share prices. We also saw some of our bigger hyperscaler holdings do very, very well, whether it was Alphabet or Amazon. All these companies in their earnings for the second quarter basically increased their expectations for their spend for the balance of this year and for next year. So we still see that as an exciting space where good performance is going to come if you own the right names in those sectors, and we make sure we have a diversified mix of names there, so we're not betting solely on the chip makers, or we're not just betting on the Mag 7, but rather a more diverse portfolio of firms that benefit in that space. And I think despite the jump in energy prices and the volatility that comes from the war, the world economy is doing well. Labor markets are still very firm. While hiring isn't soaring, there are virtually no layoffs. So good signs from the labor market, good signs from consumer spending, good signs from the CapEx from AI, good signs from the defense sectors, good signs from the growing demand for more power and the need to invest there. Central banks are certainly taking notice of this. They have been unnerved by what's happening in energy prices. With the exception of the ECB that did a small hike in June, they've really been pretty calm. The bias on all the central banks' part is to, at some point, begin raising rates again, because inflation, with the exception of the ECB, has remained above target, and now the ECB is back above target, and all the major economies have seen inflation stay above target now, like in the case of the Fed, we're in the 6th year of the Fed missing its inflation target. So Either they've changed their inflation target and haven't told us about it, and the new chair, Kevin Warsh, has denied that that is the case, or they're going to have to start taking actions to try to slow things down. But if they're tightening because growth is strong, I think markets can withstand that. If they are tightening because they are so worried about inflation running away and they don't care about what that does to activity, that would be a more worrisome prospect for equities. But I don't think we're anywhere near that scenario. So we still see it's a healthy global macro environment for world growth. And the earnings numbers that we are getting for the second quarter are, in many cases, a little short of astounding. Just excellent earnings, not only in the US, but in much of the world. And I think that's going to continue to drive equity prices higher as well. The fixed income markets, unlike the equity markets, have really struggled this year. And July was a very poor month for them. I would say the US, European, and UK bond markets, if you look at them as a sort of an aggregate combination of government bonds and investment grade bonds across all maturities, they all lost money on the month. It is just continued generous social spending that has followed us since the pandemic, combined with now a need to spend much more money on defense. You have governments just continuing to borrow money on the social front. You have them borrowing more money now for defense, and then you have the private sector's credit demand growing. This is all creating just a greater demand for capital that is driving up yields in the longer end of the bond curves. It's not dramatic, it's subtle, it's steady, it's slow, but it is an issue that periodically can really come back to haunt markets. And it is why we continue, where we hold fixed income in solutions and cautious, to be on the fronter end of yield curves where you're paid 4+%, and you're not taking a lot of duration risk in the portfolio. And we expect to continue to hold that kind of provisioning in the funds for the balance of the year and certainly well into 2027.